Part 2 of this course. Any questions first on this first part on the agents?
No.
Okay. Well, with that, if you do have some, let me know. In terms of part 2, the business structures. Okay. So you ask yourself, well, how does that tie into to agency? Well, if you think about a business is representing you, the owner. So business sort of becomes the agent of you, right? And the question is, how separate are you from that business? So what we're looking at is 3 different business structures in here. We're looking at sole proprietorship, a partnership, and a corporation. And we're looking at this relationship between the owner and the business, and what the liabilities are and what the obligations are in each of them. So we're going to distinguish the 3 types of methods of carrying on business. We're going to compare the advantages and disadvantages of each. We're going to explain how how partners might try to limit the risk in a partnership relationship or in a corporation relationship. We're going to consider risks of not planning how business will evolve, and that is a very serious concern for people entering business. We're going to understand the methods and objectives of incorporation, and we're going to consider duties and obligations of the directors and the shareholders, and we'll review the ethical business practices related to that and understand the various methods of funding these corporate activities. So effectively, we've got 3 distinct business types, as I say, and each of those structures carries a different setup arrangement and different liabilities. But each of them also allow for an individual who owns that business to make money, to make a profit. And each of those structures, over the course of the years, government has seen some of the problems and created legislation related to the operation of these business structures and what needs to be done there. So each structure must comply with these regulations, and things like taxation and the like needs to be taken care of. In terms of the common business structures, what we're looking at here are really the components of each of the 3. Okay, so if we're looking at a sole proprietorship, in a sole proprietorship, we have one single individual, one person. And that business carries out its operations with that owner. So it's a one business, one person. Now, they could have employees, but in terms of the ownership, one business, one person. The other thing is that a sole proprietorship, there's no difference between the company and the person in the eyes of the law. So it is not a separate legal entity. So if the business does you wrong, like you go buy something from a business that is a sole proprietorship, the business does you wrong, you will sue the person who owns the business because there's no distinction between the business and the person who owns it. Further, that person who owns it has unlimited liability for that business. So if you sued that business for $1 million, that owner would be responsible for that $1 million bill. So, and you know, this from an owner's point of view, that's a real danger, isn't it? Because you're going to say, okay, someone sues me and I'm a sole proprietorship. Man, I could lose my business, my house, my car, everything. So it's a very risky type of operation in law. It's a very simple type of operation in setup and operation from a business point of view. But in law, it is a highly risky business because of the fact of this unlimited personal liability. Now, there are things you can do to mitigate liability, such as insurance, but the fact is all that costs money and you need to be prepared to pay it. The second type of business is a partnership. The partnership involves 2 or more people. Okay, it has to have at least 2. And when I use the word people, I'm not only talking about people who are flesh and blood, real people, but I'm also talking about corporations, because a corporation, for the purposes of the law, is a person. Okay, so Individuals carry out a business with other individuals or other people or other corporations are known as partnerships. The thing is with a partnership is it is not, like a sole proprietorship, is not a separate legal entity. So if I were to sue, if I were to buy something, there's two of you who own a business, I sue you, I sue both of you. I sue both of you. And like the sole proprietorship, you have unlimited personal liability, meaning if I sue you for $1 million, you personally are going to be on the hook for $1 million. But here's the rub with a partnership. Let's assume your partner has no money whatsoever, is zip, nothing, and you have $2 million. Okay, both of you are partners. Now, when I sue you, I'm going to sue both of you. You got no money. Your partner, however, has $2 million, and I want $1 million of it because I'm suing you. So what's going to happen with that is I'm going to win. Let's assume I win. The partner is going to pay me the $1 million. The partner with no money doesn't have to pay at all. Because one of the things in a partnership is you're said to be jointly and severely liable, meaning that if one partner can't pay the bill, the other one is expected to. So this is a real concern with partnerships, or partners in particular, that, you know, if they run into legal difficulties, the heirs of one of the partners, let's assume one of the partners went out and made this bad deal with me, the heirs of one become the responsibility of the others. So that's a bit of a challenge with a partnership relationship. The corporation is the third type, and the corporation tends to be where companies evolve, okay? Companies normally start off on the sole proprietorship partner end and eventually migrate into a corporation. Now, a corporation is a separate legal entity. So from the point of view of law, a corporation is a person. It has all of the rights and obligations of a person. And it is not a living, breathing person, but it has all the rights and obligations. So the great thing with a corporation is that if I were to sue a corporation for $1 million, I would exactly do that, sue the corporation. The owners of the corporation will be shielded by the corporation, meaning that they will only lose their investment in the corporation. Unless there's exceptional circumstances here, I cannot sue the owners individually. I have to sue the corporation. If the corporation is worth nothing, I get nothing. So the corporation is beautiful because it limits the personal liability of the owners. And the owners are shielded from any potential problems with regards to law or legal action. Now, so a corporation can be owned by one individual, so there's nothing to prevent a corporation from having one shareholder, or by two or more individuals. So it could be a kind of a sole proprietorship corporation where there's one owner of the corporation. It's just a corporation is set up in order to shield the individual. Or it can have many owners, two or more, many owners. So sole proprietorship is a simple, an individual carrying out a business activity on his own. The sole proprietor makes all the decisions associated with the business and is the only one entitled to the benefits derived from the business. So a sole proprietor also bears full responsibility of all costs, losses, and obligations incurred in the business activity. Thus, there is no distinction between the personal assets of the sole proprietor and the business. So from a sole proprietor's point of view, you like the idea of working by yourself. You don't want anyone meddling in your business. This is your idea. You figure you can make a lot of profit with it. That's great. It's wonderful from that perspective. It's all yours to win and win big, or all yours to lose and lose big. You don't have to deal with any other owners. You don't have to compromise. The decision's your own. The arguments you have are with yourself. So the sole proprietorship has those advantages, and we see here that we can list down the various advantages of sole proprietorship. So sole proprietorship, an individual carries on the business alone. Sole proprietor is the business. There's a lot fewer regulations. There's no formal process. I mean, I could say that I'm starting a sole proprietorship right here, right now. Here, I got myself a business. That's as much effort as into it. So you may register a trade name, but it's not required. If I put some sort of a fancy trade name on it, I can do that. And we've also got complete control. That's what I love about it. I'm a control freak. I got to have absolute control. So I like the sole proprietorship because of that. Now, the downside is the debts of the company become mine. There's no difference between if the company loses a lot of money, it's just like me losing a lot of money. I'm vicariously liable for the torts of the employees. So if I hire someone does something bad, I'm going to be responsible for it. And as I say, I may offset some of the liability with insurance. And the thing is with my taxes, all the profits that my business makes. So if my business makes $1 million in profit, that's taxed in my hands. So it gets added to my T4. There's no different my T4 slip coming and say I made $1 million. That's going to get taxed at my personal tax rate on that $1 million. So that creates some challenges there from a tax point of view because personal tax is higher than corporate tax. Now, a sample example of a sole proprietorship is Dee's business, Hobbyside Creations, right? So that's a simple example of a single entity company. The partnership is the simplest form of business in which people pool their resources and carry on business together with the object of making a profit. There's no real significant difference from a legal perspective between a sole proprietorship and a business partnership. The relationship is based on contract, so it applies to contract law. You know, with the owners of the business will write a contract at the beginning saying that, for example, things like each of us will put in 50% of the equity and each of us will reap 50% of the profits if there's two of us. Now, the big advantage of a partnership is no formal process, no different really than a sole proprietorship. You know, it may need to be registered with a government agency like any other business. If, for example, it's selling French fries, it needs a food establishment license, these sorts of things. Parties share the cost, participate in the management. That's the thing is the two heads are better than one scenario, so that's a big advantage there. From a negative point of view, the income is taxed at personal rates, no different than it was for sole proprietorship. And personal rates are always taxed higher. These things are regulated by the Partnership Act. And the Partnership Act really supersedes any of the common law principles. And so it at least gives some legal framework on which to make legal decisions on. There's unlimited and joint liability. So the debts are personal assets are vulnerable to the creditors. Each partner could be responsible for the debts of the other partner, vicarious liability for touching employees, and may offset liabilities with insurance. And as I say, the tax rates are higher. So it's not that much different than a sole proprietorship. To create a partnership, well, you can do it by writing a simple contract. So that's, you know, here we go. Let's start a contract. So we make a written agreement which indicates the rights and obligations of partners. I will be responsible for X, you will be responsible for Y. I will make 50% of the profits, you will make 50% of the profits, these sorts of things. So many provisions in the Partnership Act can be modified by agreement. So effectively, the Partnership Act, like the Sale of Goods Act and these sorts of things, fills in holes in contracts. So if the contract did not say something, the Partnership Act would step in and automatically apply those things to it. It can be superseded by the agreement. So it means if our agreement writes something different, that's what holds. So if the agreement is silent, the act prevails. We can also create a partnership by inadvertence. So basically, we don't write up a contract. It's just an unwritten contract, oral agreement between you and me about a business. And, you know, factors to consider here: joint contribution to capital, joint participation in management, sharing of profits, and ongoing business issues. Without having something written down, you're opening yourself to trouble, because the fact is that, you know, someone's going to have an argument later on who owns what in the business, and if one wants out, how much is it worth? So if partnership is formed without an express contract, Partnership Act governs relationships between parties, and that's why Partnership Act exists, is to cover those holes that are often in contracts. today we're going to look strictly at corporations. So a corporation is a person in law. A corporation is a separate legal entity from its owners. It has all of the legal rights and obligations that a person does. This is a critical point in terms of law. Even though that this corporation is in paper only, it's a paper name, that paper name can do all of the things in terms of contract, in terms of tort, in terms of all of the things that can be done by an individual, the corporation can do. So because of that, businesses have seen an advantage to setting up those types of things, because if it can do all the things an individual do, at the same time, it can be the one that is attacked or addressed in law or sued if there was a problem. So businesses say, yeah, let's set up a corporation because it can do all the wonderful things that a person needs to do, but also it shields us as individuals from any of the problems that may result if the corporation were to be sued. So it is a fairly efficient way of doing businesses. In fact, most businesses are set up as corporations. And these things are a function or a fiction of law because they're artificially created people, and they're created by statute as a separate legal entity. There is such an act as the Corporations Act. And what the Corporations Act does is it lays out how a corporation needs to be set up and the various powers of a corporation to contract and to do all of the things that a person can do, and the limitations of a corporation in terms of the legal limitations to people suing the corporation. So the corporation exists and it has rights separate and apart from the shareholders or directors. Now, shareholders and directors are effectively the owners of the corporation, okay? The way a corporation gets set up is in law, the corporation is set up as an entity. Lawyers set it up through the Corporations Act. It gets a registered name, and that name may be a bunch of numbers. It may be a corporation name, like Bombardier in this example. And what that corporation does, it allows ownership by selling shares. Now, if there's two owners, let's assume that it's what we call a closely held corporation. There doesn't need to be two, it could be one person, but let's just say two for the purposes here. There are two owners of that corporation, or two shareholders, and they have one share each. Okay, so the two people can form a corporation, they have one share each. And what the share does is entitles them to a portion of ownership of the corporation. In the case of two, each one has one, so that's 1/2 of the corporation is owned by each individual. And shareholders, in most corporations, in publicly traded corporations, ones that are available for you or I to buy shares in, corporations have many, many shares. So usually in the Constitution, when the corporation is set up in law, it will say how many shares it can issue. So it could be up to 1 million shares, it could be 10 million shares, it could be 100 shares, it could be 2 shares, whatever. But the fact of the matter is the Articles of Incorporation define how many shares the corporation can own. So theoretically, a corporation could have many, 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 many owners. And in the case of a corporation that has many, many, many owners, how do you manage the corporation? You know, do we ask for a vote of 1,000 members? That's not practical, okay? So what we do is we set up what's called boards of directors. And a board of directors are elected by all of the shareholders of the corporation. So let's assume that there's 1,000 shares to the corporation. The shareholders will hold what's called an annual meeting. And at that point in time, some people will stand up and say, I would like to be a director. Vote for me. Vote for me. So in the Articles of Incorporation for the business will say that it has a board of directors of 10 members. Okay, so that means there's 10 available spaces for people who are shareholders to be elected to the board to closely manage the corporation. So those shareholders then are at the general meeting, they put their name forward, and there's a voting process. And the voting process then will install 10 members in the board of directors, and those people will be directly responsible for the operations of the corporation. So that means the other 990 shareholders don't have to focus too much on the day-to-day operations of the corporation. In fact, what normally happens is the board of directors will hire professional staff to run the corporation. The day-to-day activities, the board of directors will run the corporation. I just happen to be, you wonder what I said, I had a meeting before this. I have a meeting because I sit on a board of directors for a corporation called the Town of Clarenville. And the town is a corporation, and there are 7 elected board members. They're called town councilors. And they have a vote on, they manage the town on a regular basis. Do we actually drive the tractors and things? No. We hire people to do that, so there is a staff, but the board manages the staff. Okay, so our job as counselors is to ensure the staff are doing the things that we've hired them to do. And so that's effectively how the board of directors work, is that the board of directors is just a close group of the shareholders who take over the regular, manage the regular operations, and they owe a duty, in terms of a duty in law, once they're a director, to manage that corporation on behalf of all of the other shareholders. Okay, now, in all jurisdictions, the basic structures, rights, and responsibilities those involved, and the methods for financing them are the same. So we look across the country. There's provincially incorporated businesses, and provincially incorporated businesses tend to operate within the province that they're incorporated in. And there are federally incorporated businesses, and these federally incorporated businesses tend to operate across the country. So depending on which jurisdiction you're in is where you're going to really be set up. Most corporations in Newfoundland, for example, would be provincially established corporations. The town of Clarenville, for example, is a provincially established corporation. The basic structure of those is the same, the board of directors, the voting shares, the share offerings, these sorts of things. Now, the way that the way that the board of directors are put in place is through a voting process. Well, every year, corporations should have an annual general meeting. Usually, the charter or the constitution of the corporation, which is part of the articles of incorporation, will say that the corporation shall have an annual general meeting once a year or twice a year or whatever the numbers are. And the board of directors then are up for election. Again, depending on the corporation, some directors' positions may last for 4 years or 3 years or 2 years or 1 year, depending on the individual corporation, how it's set up. So people have an opportunity to go to the meeting and make their case to be elected to the board of directors. The creation of a corporation is the fundamental start of any corporation. So let's assume that we're talking businesses here now. The business started off as a sole proprietorship or a partnership. The owners see the advantage of creating a corporation because of the legal benefits it gives them, as well as the taxation benefits it gives them. So what do they need to do? Well, the corporation can be created, as I say, under a federal or provincial or territorial statute using one of 3 methods. Now, the one of 3 methods really do not apply to all provinces, okay? So we've got this memorandum of association. That's in Nova Scotia. So we don't have to worry about that. We don't have that here in Newfoundland. We also have letters of patent. That's in Quebec and PEI. It's not applicable here. What we had to have in Newfoundland and Labrador is what's called an article of incorporation. And any law firm or any lawyer can draw this up, which is it's a document that outlines to the provincial regulatory body for the Corporations Act what the name of the corporation is, what its purpose is, how many shares, who are the board of directors, all of these sorts of things. It will outline the basic what we call the constitutional elements of the corporation. So these articles and corporations are filed with the provincial government, and the provincial government reviews them. And once they review them, a certificate of incorporation is issued. So the corporation becomes what's called a registered company. And so that registered company then can operate as a corporation and be entitled to all the benefits and privileges of a corporation. So the incorporation documents are the constitution of the company, such as the established name, share structure, number and power of directors, any restrictions on the type of business, etc. Each corporation has bylaws, and you can see in the corporation agreements, all incorporation agreements have bylaws which set out the normal operating rules, responsibilities of the directors, officers, and the management of the organization. Usually, like, for example, the organizational structure of the organization would be there. The responsibilities of the directors, what they're supposed to do, what they're not supposed to do. The operating rules could be, for example, that the corporation must have a meeting annually. The corporation can't issue any more than X number of shares, these sorts of things. And corporations that are incorporated federally can operate across Canada. So that's, larger corporations, usually ones that are traded on the stock market, would be federally registered. There are two basic types of corporations, as I just referenced. There's broadly held corporations and closely held corporations. Broadly held corporations are the big companies that we see, okay? These are companies that are what we call public, and that means that anyone in the public can buy shares in that corporation. It's, if you look at the stock market, you used to be able to see in the newspapers, the stock tables used to be in newspapers. Now you can see online. And look at all the corporations, and you could potentially buy shares in it. So there's to buy a share in a corporation, you can just, online, you can do it. You can go to any of the banks right now, and you go to the website, and you can effectively, by clicking a few buttons, allow yourself to buy some shares in a corporation, okay? The corporation of your choice. The shares are traded on the stock market. So effectively, what happens is that, let's say, for example, you go buy some shares in, I'm going to use Bombardier because it's the example I've run through here. You buy some shares in Bombardier. There might be some limitations put on the bank by how many shares you have to buy. Like, you can't buy one share, you got to buy, I don't know, lots of 100 or something like that. There could be any number of restrictions on it. Again, it depends. And so you go buy shares in the corporation and you transfer the money, and effectively, voila, you are an owner of the corporation. You could easily sell them again tomorrow. And that's what the stock exchange or the stock market is designed to do. It's a meeting place for buyers and sellers of stocks at a corporation. They're sold just like tomatoes. You can sell it for a price. If someone wants to buy it for the price, that you're willing to sell it for, you can sell it. So you can exchange. So you can imagine that shareholders in a widely held corporation change every single day who the names of the individuals are. In fact, most corporations are owned by pension funds, which are chunks of money that you and I put money into. Broadly held corporations have a tremendous amount of regulations around them. Obviously they do, because look, this is hundreds of millions of dollars that is in these corporations that the general public, people's retirement incomes, a lot of that depend on this. So they have very strict regulations with regards to reporting, the use of all of the requirements that that government would impose on them. The other type of corporation is a closely held corporation. And usually, of course, a closely held corporation is literally closely held by its owners. So not everyone can buy a share in that. I suppose if you knock on the door and say, hey, I'd like to buy, part of this company, the closely held shareholders could let you in. But as a general rule, they're private corporations with few shareholders. So, as I say, a corporation with two owners. There's two shares available. One has one share, the other one has the other share. And there's all kinds of restrictions on transferability of shares. Why is that, you ask? Well, if you and I are into a corporation, we own a corporation that is a pharmacy, let's say, for example, and I say, I'm selling my share to Joe Blow. You have no say in that. You're going to have to work with Joe Blow because there's only two of you. And if Joe Blow is not someone to your liking, probably that's not going to work very well for you. So there are restrictions on the transferability because really the numbers are so few in terms of the owners that all the owners really need to agree to let this person into the group. Unlike a large, widely held corporation where no one really has any, one new person in and three people leaving isn't really going to make a big difference when there's a million owners. The shareholders are members of the corporation, but really owe no duty to it. So again, where the corporation is an entity in and of itself, you owe no duty to it in particular, other than the fact that you are an owner. And you're separate from the corporation itself. So if something bad happens to the corporation, it doesn't mean anything bad is going to happen to you, other than the fact you might lose your investment in the corporation. So you have what's called a right to vote at the shareholder meetings if you own the right type of shares. Okay, we'll get into the type of shares after. But normally, for a normal corporation, let's say an average corporation, you buy what's called a common share. And what we mean by a common share is a share that comes with voting rights. And it's one vote per share. So if you own 10 shares, you get 10 votes. If you own one share, you get one vote. If there's only 100 shares in the corporation and you own 10 shares, you own 10% of the corporation. So you have a lot of sway as an owner. If you own 90 shares and there's only 100 shares, you own control of the corporation, right? So you can, the amount of shares you have affects how much control you have over the corporation. And we got this word called proxy too. Another thing is, let's say, for example, you can't make it to the annual general meeting, okay, where the voting takes place. Every year there's votes on certain things. Corporation wants to issue more shares, for example, okay? The trick is that if you can't make the meeting, that means you lose your vote? Well, not necessarily. What you can do is you can transfer your voting power to somebody else. It's called a proxy. So your son or daughter, you send them off to the meeting, and they can take your vote and they can vote on your behalf. Now, it's up to you whether you tell them which way to vote or not. That's really irrelevant. The fact of the matter is they can vote on your behalf. These are known as proxy shares. Some corporations will go out, I've had it come in the mail, some corporations will go out and ask for your proxies. So they'll basically ask for your votes. So you give them the power to vote towards a certain thing. So effectively, this voting, whether it be in your own vote or a proxy vote, will allow the directors to be elected. So certain people are, there's a bunch of people going to put their names forward. There'll be like a little election, and these people will all have certain, I'm going to say platforms. They'll say, I want to see this corporation offer more shares, and if you vote for me, that's what I'll push for. That sort of thing. No different than what you have in a regular election in politics. The elected directors then are put in place, and they supervise the management of the operation. So the management are the hired staff. So you got to be able to distinctly make that distinction. Now, shareholders are the owners. They, in turn, hire professionals to run the business. These are paid help. So the board of directors manages the paid help. And the majority shareholder ultimately has control. What I mean by majority is greater than 50%. If you got greater than 50% of the votes because you own greater than 50% of the shares, you are what's called a majority shareholder, and you have the ability to basically run the corporation because you have more votes than anyone else. And when you have a vote, you're going to put 51 votes in out of a total of 100. So whatever you say is going to go. It's democracy. Sometimes in large corporations, publicly traded corporations, and again, it depends on their constitution, what they say, the type of shares that they can issue. But sometimes large corporations, such as Bombardier, have two different types of shares. In fact, they could have multiple types of shares, but two broad types of shares, we'll call it. The first type of share is called a common share. And a common share, as the name implies, is a typical share in a company that if you own a share in that company, you get one vote. And that share entitles you to whatever the percentage ownership of the business that share constitutes. So if there's a total 100 shares, and you have one 1/100th of the business is owned by you. If the business dissolved tomorrow, you would get 1/100th of the payout that would come from the sale of the business. With that vote, with that common share comes a vote, and it also comes an opportunity for what I call a dividend. Now, you've done enough accounting by now. You've done a couple courses in accounting to know that dividends are payments of profit that go to the shareholders. So the thing is, let's assume that same corporation with 100 shares makes $100,000. Let's assume there was $100,000 profit. That company reports $100,000 profit last year. You're at the meeting, the annual general meeting, and there is a motion on the floor to pay out $100,000 in dividends. Okay, so there's 100 shareholders. That means the dividend would be $1,000 per person. $100,000 is the total profit. There's 100 shareholders. We're going to pay it all out. That means everybody gets $1,000. That would have to be the vote. Now, the thing is, corporations don't normally pay out all of their profit. You want to save some of the profit to reinvest into business, right? So let's say, for example, the business wants to buy a new building or do something like that. It wouldn't make sense, and it's probably not prudent to pay out all the profit the business makes. So let's assume the business decides to pay out half its profit for the year in dividends. So that means that'd be $50,000. So that means each shareholder would get $500 if there's 100 shares. That's all that means. Again, those are the types of things that are voted on in the meeting. What amount of dividend will be provided? Usually the board of directors discusses it long before their meeting ever starts to say, we're going to offer up that we pay out a 10-cent dividend or a 50-cent dividend or something like that. And that comes drawn right out of profits of the business. Now, you got in mind that when you spend that money, you give that money back to the shareholders. The business doesn't have that money in order to invest and do whatever it does further. So businesses, if they don't make any money, they can still pay out dividends, but the problem is coming out of your equity in your business. Okay, so there's another type of shareholder called a preferred shareholder. And a preferred shareholder, as the name implies, is preferred. Now, preferred in the sense that a preferred dividend is usually guaranteed. Okay, so effectively, a preferred share will come with a dividend of, I don't know, 5 cents a share, and that's going to be paid out, and that's pretty standard, and you know, it doesn't matter every year. So it's like clockwork. It like plays out interest. So a preferred share, you can imagine people liking them because they are guaranteed in terms of their payout and guaranteed in terms of a cash flow from the owner's perspective. The trick is with a preferred share, the downside is it doesn't carry any voting privileges. So the people who are preferred shareholders, even though they're guaranteed to get a certain amount of revenue out of that share by owning it every year, they're not enabled to vote. So they don't have any voting rights. The other thing with the preferred share, if the business went bankrupt or belly up or shut down tomorrow, the preferred shareholders would be the first ones to get paid. So, you know, if the business liquidated and the business, you know, there was a bunch of money that came out of the business, the preferred shareholders get paid first. If there's any money left over, the common shareholders get paid. If the business were to liquidate and the amount of money that was left over was only enough to pay off the preferred shareholders, they're the only ones that would get paid. Common shareholders will get nothing. So, you know, that is one of the tricks with this the share issue is that preferred shareholders is a more a safer, I'll call it a safer investment for people who are concerned about safety. And for a lot of pension funds and the like, preferred shares is the preferred way to go. As I said, the important thing is that we have to recognize with a corporation is the fact that it is a separate legal entity, and the corporations have the same powers as a natural person. So all their activities are carried out through agents. Seeing the corporation doesn't have any arms or legs or mouth to do anything, the corporation is full of agents, people acting on its behalf. So, you think of the management of corporation, they are empowered to contract on behalf of the corporation. So if ABC Corporation is in the ditch digging business, and so the managers of ABC put in a tender for a big ditching operation somewhere, and they win the contract, it binds ABC Corporation to do the work, just like an agent would. There are some exceptions to this, and usually it's for crown corporations or like special statutes. But for the average corporation, the agents bind the corporation. The thing is that what small business owners like about corporation is this issue right here, the limit of liability. So the debts and liabilities remain with the corporation. So if the corporation were to get sued for a lot of money, more than the corporation is worth, the corporation will be liquidated. Okay, and the money basically would go to the person who sued. But you can only squeeze as much juice out of the lemon as the lemon has. It is very much limiting how much obligation there would be. So generally, shareholders, directors, and other participants are not liable for the debts of the corporation. And the courts could lift the corporate veil if, under certain situations, that the directors or shareholders were responsible. So if there was fraud or some sort of deceit or criminal activity, people cannot hide behind the Corporations Act or the limited liability feature of a corporation if they're doing something untoward. The courts will look and say, no, you guys just set up the corporation to shed yourselves. We're not going to allow that to happen. The other good thing with a corporation that small business owners must be aware of is it doesn't die. If a partner were to die or the sole proprietor were to die in those types of arrangements, the business would certainly be non-existent because the sole proprietorship, certainly it wouldn't be existent because the sole proprietor is no longer with us. In a partnership, it would throw, depending on what the partnership agreement said, and again, if the partnership is silent, the partnership would cease to exist if one of the partners died. The corporation, on the other hand, where it has shareholders, and these shareholders can change and continue, the corporation continues on to an indefinite life. And management is separate from the ownership. As I say, you hire professional managers. So the managers are absolutely answerable to the board of directors. And if the management don't do what the board of directors feel that is in the best interest of the corporation, the management will be fired. What do the shareholders get out of a corporation? What does the Corporations Act say that the shareholders, particularly common shareholders specifically, they get the right to vote? They get the right to a share dividend if it's declared. That is, the board of directors has to decide at the meeting, are we going to pay out a dividend this year? We could choose not to. If the company made $100,000 and there's 100 shareholders, there's nothing in this world that says the corporation has to pay anything out to the common shareholders. They could decide to keep all those earnings and reinvest them, right? So that's usually up for a vote at the annual general meeting. Should we or should we not issue a dividend? The right to share the assets upon dissolution. So if the corporation, for example, were to dissolve tomorrow, let's liquidate the corporation, shut it down. The shareholders would be allocated the proceeds according to their share of ownership. The shareholders have a right to inspect certain records, And that's standard. You know, if you own a business, you're totally entitled to look at the records of it. And minority shareholders have the right to dissent. Okay, so if you're one little voice in the wilderness, you own 1/100th of the corporation, there's nothing wrong with you disagreeing. The voting process allows for you to say nay. You know, 99 hands could go up and say yay, but there's nothing to prevent one person from saying nay. So disagreements with the directors on major change that's good for the corporation but hurts the minority shareholders. What does that mean? Well, let's take a look. You buy shares in the corporation. Okay, let's do a little bit of mental math here. Now work with me on this. Okay, we have got a corporation that has 100 shares. Okay, there's 100 shares in the corporation. And let's assume, as I said, that the corporation made $100,000 this year, and it decides to pay out all of it. So that means each shareholder would get $1,000 in dividends. Fair enough? But let's assume at the same time, the corporation has a meeting and it says to its owners, shareholders, we have decided to issue 100 more shares. We would like the right to offer 100 more shares of the corporation. So there was 100 shares in the corporation to start with. What the board of directors wants to do is issue 100 more shares. Why would they want to do that? Well, it makes sense. You know, you could go off and look for 100 more shares. You'd sell them. That would bring money into the corporation. It would be, you know, it'd be financing the corporation. It'd be developing equity in the corporation. You know, they sell the shares, bring some money into the corporation. The corporation could do what I want. Sometimes corporations want to sell more shares. No question about it. It makes sense. But let's be that one shareholder. Now, I want you to be the minority shareholder. I want you to be the one shareholder. And you're looking at this and you're saying to yourself, okay, there's 100 shares. There's $100,000 in profit. They're going to pay out a dividend of all of that money. So that means I'm going to be entitled to $1,000. Great. In the next motion, it says, okay, we're going to issue 100 more shares in the corporation. So effectively, there are now 200 shares in the corporation. Okay. And again, there's $100,000 in profit that is going to be split over, instead of 100 shares, now it's going to be split over 200 shares. So you just saw your dividend drop from $1,000 to $500 because we doubled the number of shares in the corporation. You're probably not going to be too happy with that. So this is what we are talking about. When the word oppression action is what happens when the shares get devalued for a corporation by the fact that they've issued more shares. And a lot of shareholders, minority shareholders, might not be too happy if the number of shares in a corporation increases, because it effectively dissolves or dilutes. That's the word I'm looking for. It dilutes the number of shares, and as a result, the amount of dividend gets diluted and you wouldn't make as much. So this is what we call oppressive actions. This is an action that effectively negatively affects the shareholders of the corporation. So what can corporations do? Okay, you know, it's perfectly legitimate that a corporation wants to offer more shares. But at the same time, you can understand that some people in the corporation might not be too happy that more shares got issued. So normally what happens is, in a shareholder agreement or in the Constitution, we have something called preemptive rights. And preemptive rights is a right that existing shareholders have to buy any new shares at a better rate. So what's going to happen is, we're at the same meeting and the board of directors says we want to issue 100 more shares. But effectively, we're going to offer them up first to the existing shareholders. That means you have the option to buy those shares and invest more in the business. And that means that you would not effectively see your total dividend diluted. The amount of dividend per share is going to drop, no question. But if you own twice as many shares and the dividend got cut by half, you're still, or the effective dividend per share is cut in half because you doubled the number of shares. You're in no worse a situation than you were when you started. So preemptive rights basically give a right to shareholders who are existing shareholders, bona fide shareholders, the right to buy the shares first. And that prevents this dilution problem that happens. Sometimes, for example, if shareholders feel that they were hoodwinked, they can take what's called representative action, which is where the minority shareholders bring action for damages against the corporation because of the fact that they diluted their shares. And corporations have to be careful of that. They don't want to tick off their shareholders. Okay, so the next thing is this board of directors. And the board of directors are the people who are elected to run, not run the corporation. They were elected to manage the affairs of the corporation and look over the management, watch the management, and ensure that management are doing their job. So they're the people who are kind of on the steering wheel, driving the car. Okay, the rest of us are in the car. We elect people to drive the car. So they're elected by the shareholders. Their duty is to the corporation itself. Their job is to make sure the corporation does what the corporation is supposed to do for the benefit of all of the shareholders. And they must exercise care, diligence, and skill, a reasonably prudent person in comparable circumstances, and they have a fiduciary duty to the corporation. Now, just to give you guys some heads up on this, because I'm sure some of you might have had some experience with sitting on boards, some of you may not, but you probably will, okay? This is always a bit of a challenge when you sit on a board. When you sit on a board of directors, you're elected by the shareholders, and you have a duty to the corporation itself. And you must exercise care, diligence, and skill of a reasonably prudent person when you're sat on the board. So there is an obligation when you sit on the board to do your very best to manage the affairs of that corporation and to make sure that nothing hanky-panky is going on, that everything's above board, and that you owe this fiduciary duty to the shareholders and to the corporation to make sure the corporation is doing a good job for everyone. But let's assume something happens that you didn't know about, didn't realize, got past you, whatever, and the corporation gets sued. Theoretically, the shareholders can sue you as a board member for not doing your job. So what you need to make sure of, and this is how it impacts you, is whenever you sit on a board of directors, make sure that the corporation that you're representing has some sort of director's insurance. Because theoretically, this is in theory, as opposed to it really happens a lot. It doesn't happen very much. If you're sitting on a board of directors and something goes bad, you could be liable. Okay, so it's important that the director's insurance. So with the town, for example, as I sit on the town, our meeting was just about the audited financial statements. So we had to vote to make sure. So we got a little rundown of the town's finances, the $10 million of your money we spent. And our auditors ensured us that everything was above board and everything went well and there was no issues and these sorts of things. But let's assume that there was some issues. Let's assume there was an issue on your street. Your street had a sewer put in upside down or something like that. It was my job as a counselor to ensure that those things don't happen. And let's assume that you say, oh, I got a legal case against you. You could theoretically sue me and for not doing my job, right? So on council, we're covered by director's liability insurance. This fiduciary duty includes demonstrating honesty and good faith, passing on information to corporation, passing on business opportunities, having no conflict of interest. And that's a very important one on boards, is you cannot benefit personally by your actions. So, it wouldn't be sweet, for example, if you found out that that I voted on something with the town to buy road salt from my company, the Paul's Road Salt Company. That's what would be called a conflict of interest. I cannot do that, and I would be removed from the board if I were to do anything like that. So you got to be careful that the directors are not lining their own pockets, right? So that's what conflict of interest legislation does. And usually all boards will have some component in their constitution with regards to conflict of interest. Any violation will require a director to pay over profits. So, you can't line your own pockets. In terms of statutory duties, which is in law, here are the duties that I need to, as a board of director person. I cannot declare dividends if company is insolvent. I can't pay out money to the shareholders if there's no money to pay. Responsible for certain taxes and deductions. That's per normal. That HST, for example, the company collects HST and it has to pay it to the federal government. Responsible for unpaid wages. If we got people working for us and the company were to go belly up, those people need to get paid, and we're responsible for making sure they're paid. Responsible for environmental damage. Responsible for offenses under the Competition Act and other legislation, fraud, criminal activity. So bottom line is that directors need to be diligent, and we have to prove that we use due diligence to ensure that everything was above board. There are other parties too. We can hire what's called officers or agents of the corporation. This is your paid help, and they're appointed by the directors. So, for example, when the town hires a CAO or an employee of the town of Clareville, we can appoint them in place through a normal job process. These officers have fiduciary duty to the corporation to act on the best interests of the corporation. Obviously, they're employees; that's their job. And they also are going to share some liability with the directors, if anything goes wrong. Other parties would also include promoters. So a promoter is someone who basically has same duties as director or officials initially, and they're like the a company that would be hired, for example, to promote another company to sell shares. The town's not a good example of that, but if I had a mining company and we had shares in the mining company, that mining company could hire a promotional company to go out and promote its latest exploration activities in order to raise money. Corporate governance is a big issue for board of directors. It's always showing up in the news, some issues with it. So we've seen some real dandy issues with problems of corporate governance, and currently we've seen a great deal of vigilance and tighter regulations after a number of high-profile business scandals. Bombardier under fire for $32.6 million US given to executives under taking government cash. These sorts of things. So the ethical standards really has to be employed. We got this thing called the Global Compact. That's for large corporations who are doing business internationally. What it is, the United Nations basically said, look, corporations, if you're going to be working abroad, you really need to adhere to some ethical standard. Some corporate governance issues run into abuses that are criminal. And if the board of directors pursue criminal activities, criminal code can deal with them. So we've seen a lot of increases in that. So businesses need to implement measures to prevent and detect corporate fraud, such as loss prevention team, ethical standards, appropriate employee training, audits. These sorts of things are all designed to manage this. The last few things deal with financing, and we've already talked about this in other courses. So, equity financing is financing received through the sale of shares, and as I say, the constitution of the company will authorize share capital. How many shares can a company issue? And again, that's important. We see that because you'd end up with share dilution problems if they go issuing shares willy-nilly. And we also have debt financing, which you've also looked at. And this is loans, for example, from various organizations or bonds, debentures, whatever. And the thing is with these is you have to pay the interest on them. So it creates a cash flow problem for a business if it's short on cash flow. So in summary then, we've got this 3 levels, and sole proprietorship, partnership. We've seen this idea of a limited partnership, just coming back to it. The limited partnership is established when one of the shareholders is a corporation that has all the benefits of a corporation, and so that the live owners, or the real people in a limited partnership, are limited liability partners, and the corporation becomes the general partner, which is fully responsible. And we've got a little bit there with regards to shareholders agreements, and these are basically that lay out the specific to a company. A little bit there on joint ventures. Joint venture is 2 or more corporations that they get together specifically for a project. So for example, when we saw Hibernia being built or Hebron being built, a local company would often partner with a foreign company, a Norwegian company with some expertise in the oil industry, for example, and create a new business that would work here building that platform. And so a JV, as we normally call them, are contractual relationships between 2 companies or more companies, 2 or more, to do something, to team up for a period of time. And franchise is a business in which someone buys the idea, basically. So it's an exclusive agreement for one company to sell products and services of another in a specified area using all the names, logos, advertising with permission. Tim Hortons, McDonald's. Franchises must comply with all the franchising rules and usually require startup investment and then regular payments based on a percentage of profits or a percentage of revenues in often the case. Standard form contracts are customary. Some provinces have statutes regarding franchises. So that, in summary, is that Unit 4.